You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are watching, listening to the Financial Survival Network. I'm Kerry Lutz. It's 9/22/21. Well, we just got word from the Fed yesterday that, they're going to taper, but they're not going to raise rates. I mean, I don't know what they said, but here to help us along in understanding Fed speak is our good friend, Lobo Tiggre. And Lobo, man, what the heck did Jerome Powell say?
Well, it's really interesting that you frame it that way, Kerry, because the press release from the FOMC, which was pretty much what analysts were expecting, there were no big surprises in there. The headline from MarketWatch, it's funny, I tweeted about it because it made me laugh. The headline was, the Fed is almost ready, almost ready to start tapering. It is a strong signal that the Fed was almost ready to start tapering. I found that very amusing. For gold and silver bugs, the key though wasn't so much the taper, is that they did talk about possibly raising interest rates at the end of next year. So the end of 2022 is a little bit, the dot moved, one dot moved a little bit forward on the chart. So a little bit more hawkish, you could say, than previously, but actually a tiny baby step. I mean, if that was a hawk, it was a hawk chick that took the tiniest little first step before even thinking about flying out of the nest. So not really much. So I think that sort of milquetoast, nothing big changing, we're not rocking the boat here press release, the market liked it. The initial response was positive, not just for gold and silver, but actually the response for gold itself was quite strong. It just popped on that initial news. And then classic example, Powell opens his mouth and at first things were fine, but then somebody asked him about the rate hikes. And I can't honestly say that I'm a good enough Fed whisperer to tell you exactly which nuanced word changed people's attitudes, because he stressed that the test for raising rates is much higher than the test for tapering. And that on tapering, he's almost there. And that they may actually decide in their next meeting to change policy on the taper. They haven't changed anything yet. They're almost ready. In the next meeting they might. But that was just the taper, and that the test was so much higher for raising rates, and that that won't be to the end of next year, maybe. And somehow, though, I don't know. But that was the moment. I was watching this live as it happened. It was when he answered that question that gold suddenly screeched, pulled a U-turn, went down. Somebody is interpreting that as, they're going to tighten, and that's going to be bad for gold. Though, as you and I know, that that's this good news is bad news, upside down economy. I call it through the transitory, looking glass, like Alice in Wonderland. We're through this looking glass where everything's upside down, and higher inflation in this transitory looking glass world is bad for gold. That's crazy. Gold's an inflation hedge. Why is it bad? Well, because the Fed will raise rates, and that will be bad for gold. I think all of this is a Rube Goldberg type contraction, a string of logical assumptions that reality is going to kick to pieces once that transitory yarn unravels.
Subterfuge. And, I think, was it Alice who said about the meaning of words? Words are what I want them to mean, nothing more and nothing less. And clearly this is a case of that. It's whatever he wants it to mean. That's the way it's going to be. It's like a giant Rorschach test. And the media sees what they want to see in it, regardless of what he says.
They sure give him a free ride a lot. Like somebody asked him in the press conference, I asked him, well, we thought the transitory would be, he didn't say this, I'm paraphrasing, but he suggested that transitory should have been over by now. The September was supposed to be reopening, and that kids go back to school, parents be able to go back to work, and the transitory thing should be unwinding now. And Powell says, yeah, that's what we thought. But Delta, it's all about the Delta variant. And so it's been longer. And everybody's okay. But wait a minute. Okay, let's say it is all Delta, right? Fine. It's Delta's fault, not Powell's fault, not anybody else's fault. It's all Delta's fault. It's still not transitory. It's still lasting longer. And how long does Delta, we're going into the fall now. How long does Delta keep things locked down in flu season? And then what about Lambda or Mu or whatever the next one is after that? How is it that the media gives him such a free pass on this transitory situation is kind of beyond me. But it is what it is. And, financial survival network, Kerry, we need to survive the nonsense because reality does matter and it does come out in the end.
Yes, it does. But this is what you expect them to do. It's just who they are. And they show themselves every day what they're trying to accomplish here, which is just to reassure markets about something that the markets continue to go up, the stock market, as the economy gets worse, right? I mean, how do you
through the looking glass?
No, but one thing, that question about raising the rates, clearly a planted question, because that's what they do, because half of these media hacks actually work for the government in one form or another. That question was a plant, all right? It was all orchestrated, not to mention anything about taper or anything else in the announcement, and then to let it out when a reporter asked a setup question.
So let's say that's so, Kerry. A key point for people, and you can go back and look during previous tightening phases. The key point is that it's simply, given everything you said, let's say it's also, as you said, it's still wrong-headed for these robotic traders, and they are robotic. Like there's a human who's programming these robots, but there are these robots that then act based on these assumptions. And they're just misprogrammed. The assumptions are incorrect. That rising rates has to be bad for gold because it's good for the dollar is the train of logic. Well, but that doesn't necessarily follow. And increased rates, if they're increasing rates in response to higher inflation, what you need to know is what's happening with the real rate. Are the rate increases, if they actually tighten by 25 basis points, the markets will react a big deal, tightening. But if inflation is high at that rate, if, Delta, Lambda, Mu, whatever happens, and these shutdowns and the continuing trade conflicts, the supply disruptions, all this stuff continues, we could be in a stagflation environment. We could see those rate increases more than swamped by higher inflation. So your real rates could be going down. And there are times, Kerry, this is a fact, people can look this up. There are times where raising interest rates go hand in hand with rising gold prices because the rates increases are not keeping up with the higher inflation. And real rates, since Nixon closed the gold window, have been the number one driving factor. So it's simply incorrect to assume that, even if it's true that the Fed will do this, it's incorrect to assume that that means gold will go down. It's contrary to historical fact. And I think these robotic traders are going to have their posteriors handed to them on a platter in the not too distant future.
Well, the problem, Lobo, is that most of the people alive today were not alive during the 70s. So they never experienced transitory inflation firsthand. And the computers, the bots that they're using, the algorithms, none of them existed in the 70s either. So all they could do is do retrospective studies of market prices and what happened when inflation was really taking off. But the decade of the 70s was a horrible decade for the stock market. It didn't take off again until 1982. And really, that's when it began its present bull market when you get down to it.
Right. That's actually an important point, Kerry, because a lot of us have been pointing to the stagflation in the 70s and the lessons there. But actually, it's a fair point on the other side that the 70s are quite different from now. It's not the same circumstances. And also you had gold, which was price controlled, if you will, or the dollar was gold until 1971, at least to a degree. And so you had a natural springboard coming off that price-controlled environment. The dollar was unrealistically pegged to gold before that. So there are significant differences. I am not at all saying that, we're in the 70s all over again. I think, but the significance, though, and what's missing from the assumptions that these robots are traded with and the assumptions that the Fed and other economists use in making their projections, is basically that high inflation is a sign of growth. That if you have inflation, you have growth. That's why the Fed wants inflation. If you think about why do central bankers say they want inflation? I mean, inflation means your dollar or your euro or whatever is losing purchasing power. Why would you want that? Why is that a good thing? Well, the logic is because it means the economy is growing. What they're saying is we want a growing economy. And the sign of that is this inflation, a moderate inflation rate. But that's not true. That's the importance of the 70s. It's not that things are the same as the 70s. It's that the 70s shows that you can have high inflation without growth. It's not a cosmic law written in the firmament that high inflation means high growth. And that's actually what concerns me now, is that we're seeing all kinds of signs that we're not getting the growth. I mean, look at the employment situation. We have these, massaged baloney employment numbers where the discouraged workers don't count and so on. But if you look at the employment participation rate, 40% of the people who could be working are still not working. That is a 70s level number that I think is very eye-opening. It fell off a cliff with the pandemic. It shot back up again, and it's been it's been waffling sideways ever since. It's not improving. That's not a healthy economy. So you got inflation, and you've got an unhealthy economy, and you've got, these supply chain disruptions, all these problems. I think that the models these economists use are not connected to reality today. And I think that's partly why we see this difference on Wall Street and Main Street.
Hey, and let's not forget, the decade of the 70s was one of rapidly rising energy prices. Right? We had 2 Arab oil embargoes, which were credited with raising the price of oil from $2.30 a barrel to like $40 or $50 a barrel at its peak. Later on went down to around $11, under 10 when Reagan decontrolled oil prices. Prior to that, he walked in, it was, I think, $35, $45 a barrel. Forgive me if I don't have the numbers exactly right. So, but the point is, these rapidly escalating energy prices put a damper on the world. And this is also what we experienced before the after the crash. We had $147 a barrel oil, record prices. So in a way, there's a lot more similarities to the 70s than people want to admit. Now, an interesting phenomena is we were much more oil dependent back then and much less natural gas dependent in the 70s. Natural gas usage conversion, because it's been trading at a discount to oil for, better part of a couple of decades. So a lot of conversions took place to natural gas. A lot of petrochemical plants converted to natural gas for feedstocks. And now we see that discount. The last time I looked in the U.S., it was 43%. In Europe, natural gas per BTU is trading at a premium to oil, which is huge, because you just have to multiply price 6 times, because a million BTUs of gas is 1/6 the energy content of a barrel of oil. So 6 times 30 is $180 a barrel equivalency there. I mean, that is huge. And that's up $6 just a few months back.
I think that's really important. There's 2 ways we can go with this. Forward-looking, backward-looking. Quickly backward-looking. I think that's a very important point, Kerry, because this has been one of the things that people have been saying. Well, it's not like the 70s. We had these higher energy prices, and we've had declining energy prices. We had oil go negative, right, last year, and we're all going electric anyway. So OPEC's going away. Woohoo! Right. Well, guess what? Oil's back. It's rumors of its death have been somewhat exaggerated. But we could actually have, instead of an OPEC shock, we could actually have the green shock here, where activist investors are taking over the boards of oil companies. Now we're looking forward-looking statements here, Kerry, but also governments banning and getting very aggressive in their policy. It's like they want to, there's an initiative out there. There's a policy initiative called Stop Now, I think, on this, that intergovernment agencies and OECD initiative called Stop Now. Well, the problem with Stop Now is, well, do we have plan B ready to go? If you're going to tell people stop now and turn off their oil or gas and they don't have anything else, guess what? There's a problem, right?
Big problem.
It would be much easier to, instead of banning things, if we said, here's the better solution. Look, here's a cheaper, better energy supply. You wouldn't have to ban anything. You wouldn't have to tell people to stop now. They would switch anyway because the better mousetrap would be the way to go. And the fact that there isn't a better mousetrap means that you have to force people, which means, ironically, you could actually see the oil companies that don't go all green benefit enormously because prices could go vertical. You start shutting down supply. Let's say these optimistic electric car progressions are accurate, and we're 50% electric cars by 2040 or whatever the number is. It means you're still 50% gas burning. And if you pull the plugs in all the gas stations, right, you can't get gas. What's going to make that 50% of the cars go and everything else that depends on it? So it's like, these people are busy cutting off the branch we're sitting on before there's another branch to jump to. And this isn't a investment thesis for like tomorrow, Kerry, but I actually think that there's a coming boom in oil prices, and for the better oil plays in the space, there could be spectacular profits to be had when we get into an artificially created supply crunch on this.
And that appears to be their intention. Look, in New York State, disgraced Governor Cuomo, prevented pipelines from being built through there. He prevented fracking to get natural gas on the Marcellus Shale, which is prodigious. Could have improved the upstate New York economy, which is, has been in the doldrums for decades now.
Don't just survive, thrive. The Financial Survival Network.
Arcana Corporation is on the verge of bringing the world's highest grade silver mine into production. The Revenue Virginius mine in Colorado has proven improbable silver reserves grading nearly 37 ounces per ton silver, with an all-in sustaining production cost of only US $8 per ounce of silver. The mine is fully permitted with infrastructure already in place, and the company has announced they plan to commence production in 2020. Achieving successful production usually results in a significant upward share price re-rating on the Lassonde curve. Arcana trades under the ticker AUN in Toronto and AUNFF in New York. To learn more, go to arcana.com. That's AURCANA.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
And at the same time, New York City bans internal combustion engine cars by 2030 or whenever.
And look, there are 1.4 billion cars and light trucks on the road, and the annual rate of sales is around 80 million. So last year, I think EVs around the globe accounted for 4%, if I'm not mistaken. When's this conversion taking place? I mean, literally, Tesla would have to take over every auto plant in the world to and then you're only going to get 80 million when there's 1.4 billion. Oh yeah, well, with ride sharing, nobody's going to want to have a car anymore. Well, hey, I don't know about you, but like one of the most disgusting things in life is riding a New York City taxi cab, especially on a nice hot day.
Well, besides that, Kerry, just look at what happened. That thing of, nobody's going to want to have a car anymore. That's gone out the window since COVID hit. Everybody's been buying cars. You can't even get a car. The used car prices have gone through the roof.
I know.
Through the moonroof, because nobody wants to get in a car with everybody else and share their germs. Exactly.
That's yet another reason why this whole thing is just improbable and unfeasible. And
they used to say that it's this agenda, this green agenda, it's like the left hand doesn't know what the right hand is doing, right? They want electric cars, but on the other hand, they don't want the means for powering those electric cars.
Like copper.
Right, exactly. They're going to ban mining or they're going to turn off the power plants. And I get that it makes no sense to power your electric car with a coal-fired power plant. That's self-contradictory, though that's what's happening in a lot of places.
Of course.
I mean, California just applied for that emergency authorization to burn more hydrocarbons to power up their Teslas because they don't have enough electricity. But nuclear is obviously, the right answer, at least in the short term there. But no, that's bad. We can't have that. So
Part of the
way of looking at this now is that the left hand doesn't know what the left hand is doing because their policies are contradictory. They want everybody to go electric, but no, you can't mine or you can't generate the power that you need to go electric. So
where's the copper coming from? That's what I want to know. Where are you going to get the copper? It takes 10 years at least to build a major copper mine. Got people I know in Alaska, in Peru, in South America, and the reserves are there. They know it. But the way that mining is now with the regulations and the financial requirements, what you have to do in order to get a mine financed, it takes 10 years. There is no way to do it quicker. If there is, I'd love to see it.
And they're making it harder.
Right?
Yeah. They're torquing up the regulations in the US. There was Rio Tinto just had its big copper mine in Arizona shut down, or there was a measure to shut it down. There's also in the so-called infrastructure bill, the Dems have put in the House a provision to increase royalties on mining in the U.S. by 4% and 8%. For these big earth-moving operations that survive on margins, those are mind-killing royalties. But somehow we're supposed to go all electric without the minerals necessary to do so and without the power generation necessary to do so. So it's like I say, the left hand doesn't know what the left hand is doing here.
They're in la la land, total la la land. So, and talking about nuclear, so finally uranium prices are going higher after production has been scaled way, way back. I guess we're effectively starting to see the shrinkage of the so-called spot market, which really, as we found out, isn't really the spot market, because you could buy something on the so-called spot and take delivery in a year. That doesn't sound like the spot market to me. And then you got the Sprott ETF marching in there and literally choking off the excess supply.
Yes, it's a very interesting turn of events. I think it's really important to stress, Kerry, that the uranium metal itself, the uranium market, was already in recovery. The bottom was in late 2015. It has been a very much 2 steps forward, 1 step back kind of sawtooth pattern upwards, but it's actually been in an upward trend for the last 5 years. So it was already going upwards anyways. And we had some tailwinds from excitement about Section 232, some tailwinds, excitement about Trump's nuclear fuel working group. Didn't amount to much. Now we have Sprott, and that has really changed things. This is a material change in the market. And before Sprott started buying up uranium, and what happened there really quickly was Sprott took over the former Uranium Participation Corp, and they restructured it as a trust, like their gold and silver physical trusts. So they basically have to buy and take pounds instead of ounces off the market. And there was some excitement about this, but when the corporate takeover happened and it went live in July, nothing immediately really happened. The fireworks happened when they announced a $300 million at the market financing to raise money to buy uranium, buy physical uranium and take it off the market. That's when the fireworks started. And it went so well, they've announced they're increasing it by $1 billion. So it's now $1.3 billion of potential investment taking uranium off the market. But what happened was many of us who've been watching the space for years have been saying, well, the rising uranium prices are signs that there really isn't that much cheap uranium left on the market, right? The Japanese utilities, which didn't need so much uranium after Fukushima, they were selling it super cheap. That seems to have dried up, but nobody really knows. It's a very opaque market. What Sprott has demonstrated is that we were right, that there really wasn't that much. They went out and they bought all the $25 uranium, bought all the $28 uranium, bought all the $30 uranium, $40, $50. It's up around $50 now. It has really gone parabolic. And that shows that we were right, that the spot market was so thin that a few cheap pounds out there were keeping prices down, but there really wasn't that much supply out there. Now, what happens next will be interesting. Obviously, higher prices can cure high prices. We've seen that in many markets. Now, it takes a long time, as we were just discussing, to bring new mines back online. Even never mind new mines. We've got an OPEC-like situation where Kazatomprom and Cameco, the two biggest uranium producers, voluntarily cut production. And so presumably they'll be the first to come back online, right? They can spool back up again. But it's not so easy. It's not so easy. I mean, it takes, even with in situ mining where you're pumping solutions through the ground rather than sending trucks down into the bowels of the earth, those things, it's not just a flip of a switch. You've got to check all your wellheads. You got to do all kinds of flow testing. You got to make sure things haven't sedimented, in the field while you weren't pumping so much. There's a lot to do. And from the operators that I've talked to, it takes a minimum of 6 months, but really 6 to 12 months to spool back up again. So even if $50 is a great price, and they'd be happy to produce and sell at $50, it's not like tomorrow they can bring that supply online. However, there are other sources. Like if I was a speculator in this space and I bought uranium at $18 5 years ago, well, heck, $50 might be a great price to turn around and book a profit. Or even if I was one of these other funds, some of the other funds and even mining companies bought pounds off the market a few months ago in the $20 to $30, $25 to $30 range, thinking it was going to go up. They've got a double on that investment now. Maybe they could sell that to finance building a new mine or something. So we could see new supply come on the market that doesn't depend on new mining. It'll be interesting to see what happens. I think this is worth stressing because I don't want to be the guy telling everybody, yeah, this is it, pile in, buy. It can only go up. I think that's an irresponsible thing to say. It might keep going. If Sprott keeps buying $1.3 billion, that'll buy a lot of uranium.
It's a parabolic move, though, and we know how parabolic moves end.
Yes, but if you look at the chart back in 2007, Kerry, it's pretty smooth, actually, for more than a year, all the way up to the peak. For the 2-3 years before, it's this sort of volcanic rise. Now, those are monthly data points, so it's kind of hard, and I'm sure there were daily wiggles. But the fact is that from 2001 to 2007, it was mostly a one-way street. Now, that doesn't mean this one has to be just like that one. But if it is, if that's the model, it could be that the retreats are pretty small and short-lived. And in a future monthly chart, you won't even see them. So it is possible that we're off to the races now and that this is something to jump on. But at the same time, I don't want to be the guy saying, buy, pay anything, get in now, because I think that's irresponsible. There are always wiggles. 2 steps forward, 1 step back has been the pattern for the last 5 years. And at least that's what I've been telling my readers, is that it's look for those retreats. And in fact, as you and I speak, uranium has corrected down to 49.75. The stocks got hammered late last week with the markets retreating. And that was just the kind of buying opportunity I've been telling people to do. So I never tell people to chase stocks, even if I'm really bullish as I am in this space.
Yeah. It's similar to what's happening with natural gas. That's why I don't think it's transitory. I said back in April of last year when copper started going up again, said this is an inflation play. It's not an economic growth play. And everyone said, oh, China this, China that, and the global economy. I said, no. You just printed trillions of dollars of currency units. It's chasing the same amount of stuff, actually less, because everything's been shut down. Higher inflation, and the copper move proved it. So natural gas is a similar situation to uranium, because it's been trading, the redheaded stepchild
right.
of the energy patch, really. And it was trading down as low as like $2. And as a result, all the wet gas wells, those kept producing because they were, the distillates, condensates, all that traded a higher price. But there were thousands and thousands of shut-in wells in the United States, fracked nat gas wells, because they were dry wells and it wasn't economically feasible to pump them. Nobody is talking about those wells. I can't find any mention of it anywhere, Lobo. Do you have any insight into that?
No, I have to say I'm more focused on the metal side of the resource sector. I am obviously interested in energy. But I don't claim to be an oil and gas expert, and I rely on others who are when I go into that space. So I'm not going to venture out on a limb. But I do want to say that I agree with you that it's an inflation play, but there is more to it. I mean, there are specific structural issues there, particularly in Europe, right?
Yes.
These pipelines. And it's a funny thing, you slap sanctions on them and they don't want to run the pipelines at full capacity. Imagine that. So this is part of the energy situation over there. So it's not just structural in the industry. It's also geopolitical, at least over there on the other side of the pond. And it's hard to see that resolving anytime soon. I don't see that just going away overnight, unless Europe does a political U-turn.
Another dumb move on the part of the United States, not having more LNG terminals to help satiate that demand, because before the run-up, before it hit $30, which is just unbelievable, it was at $6, $6 to $8. And our gas here was at $3 or $2. And sometimes even lower. Certain times of the year, it would go down below $2. And rather than building more terminals and getting the stuff where it should go, we did nothing. We activated a couple of them.
One more thing about this, though, too, is in this particular political context in the world, too, like the gas industry calls it natural gas. Oh, it's got to be good, right? It's natural. And they call it clean natural gas. But even if you have the cleanest, most natural gas in the world with as little sulfur in there as possible or whatever, it's still got carbon in it. It's a hydrocarbon, right? So you're still dumping CO2 in the atmosphere with the cleanest, most natural gas you can burn in the world. Now, I'm not jumping on the climate change bandwagon. I'm just
keep this a secret. Don't tell them this.
Well, no, there's a point to this. What I'm saying, though, is that in this context, you'd think that some of these people, particularly in Europe, would get a clue and say, well, you know what? Maybe we don't want to burn those hydrocarbons. Maybe we should reconsider nuclear. And maybe in sunny places like Germany, we shouldn't be shutting down our nuclear power plants anyway. And by the way, and it's not just the sunny Germany, the wind power. I was reading I think just a day or two ago, I saw a headline about it was last week. There was a headline about how the record high energy prices in Europe were driven by the wind not blowing in the North Sea. Right? They have all these big offshore wind farms. It's not just one of them, but they had an unseasonably calm August, and that caused less energy generation. So, maybe, just maybe, some folks over there will start rethinking nuclear.
Yeah, among other things. And look, nat gas is the least harmful of the so-called hydrocarbon fuels, for sure. It's the least harmful, the cleanest. And although if you've ever been by a nat gas fired power plant, you will see lots of yellow coming out of the smokestack for sulfur. And that's just a fact of life. Sulfur dioxide is a byproduct of burning hydrocarbons, sorry. And but the other thing is, the average person alive today thinks that they turn the switch on and the lights come on, and they're completely oblivious to how the electric got to their house, got to their apartment, their condo, and how the lights work. Right? They don't know. They have no understanding that there are like very complex geopolitical, economic forces at work.
Or even just the engineering facts, Kerry. Yeah. I remember I lived in Utah when they were building, they had the project to build a light rail train through the central corridor in Salt Lake City. And at the time, I don't know if this is still the case, but at the time, this was all, we're going to get cars off the road. They're going to be less smog, a nice, clean electric train. But at the time, something like 5 out of 6, I don't know, remember the exact numbers, but the majority of the power plants that would supply electricity to that train were coal-fired. So you were going to reduce your smog on one end, but create it on the other end. And people just, they don't think about that.
Yeah.
But actually, I want to jump back on something else you said about spooling up the natural gas conversation. You compared it to copper, and you talked about how this is an inflation scenario. I do think there's another part of that that's really interesting, and that is that we saw the Chinese dip into their strategic reserves for copper, for aluminum, more recently for petroleum products due to high prices. And what happened? Nothing. I mean, okay, the prices wobbled, but not much. Copper, last I saw, still over $4, which is a tremendous price, even though that was the big one. Everybody was worried that the Chinese were going to crash the copper price. It had a marginal impact. And the more recent one on oil, it went from 70 to 69. Woohoo, giant crash. And last I saw, it was back up again. It's $72 right now as you and I speak.
I love it.
So
that's great.
I think that's actually pretty interesting, because there was a big fear in this sector, in the whole commodity sector writ large, is, well, what happens if China cools off? What happens if China does this, that, or the other? And we just saw China take significant actions with very little impact on commodities prices. That makes me optimistic.
And let's not forget who they were blaming for the higher prices. So this has nothing to do with market forces, demand, shortages, nothing to do with excess currency units. It was those evil speculators, those profiteers. They were engineering it, the whole thing, to undermine China. Hey, I wish we had more time, Lobo. We could talk about what's happening in China, but we don't. We'll save that for next time. Just tell us the best place to find you. I assume it's independentspeculator.com. That's your site.
Yes, Kerry, thanks for pointing that out. And, I just real quick, obviously, I hope to do business with the audience, but I do have a free service. It's called the Speculator's Digest. It's a weekly email, original research, not published anywhere else. And if you sign up, we promise we will not spam you with a flood of advertisements on a daily basis. That's not what we do. So that's the simplest way to check out my work, and consider if you're interested in diving deeper.
All right. Hey, appreciate you coming on. If you got a question for Lobo, shoot me an email to kl@kerrylutz.com. Don't forget, get our free newsletter also at financialsurvivalnetwork.com. Lobo, always a pleasure. Thanks for coming on. Appreciate it.
Thank you, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.